Good morning from cold and cloudy Chicago. I'm John Kosar, Chief Market Strategist and Portfolio Manager at Asbury Research. Thanks for viewing our latest Following the Money bi-weekly podcast. Today is Sunday, April 19th, 2026. Since I was with you exactly 2 weeks ago, the U.S. stock market has staged a very sharp V-shaped rebound, with the S&P 500 surging roughly 10% and pushing to new all-time highs after briefly nearing correction territory at the very end of March. The March 30th market bottom in the S&P 500 coincided almost exactly with a very specific shift in tone and messaging from Donald Trump and the White House, specifically a less aggressive stance towards Iran, including a shift to emphasis towards containment versus immediate escalation in the war, and that the U.S. was not rushing into a broader conflict. This triggered a rapid return of investor capital into U.S. equities, although the move has been really fast and at times narrow in its leadership. In just a minute or so, we're going to look at some key charts, some important data series, and some of Asbury Research's own data-driven models pertaining to all of this activity that we've seen over the past couple of weeks. But before we do, let me take just a minute or so to tell you a little bit about us. Asbury Research is a registered investment advisor. We've been providing investment research to both individuals and professional money managers since 2005, which makes this our 21st year in business. We utilize what we call dynamic diversification or intelligent diversification, as opposed to static diversification, or what I call set it and forget it investing, which is typically the standard allocation program for most advisors. The advisor typically has you in his office. He asks you a list of questions in the beginning of the relationship, and then based on the answers that you give him, you're set up on some variation of a static 60-40 portfolio. Might have a little bit of gold in it, a little bit of silver, might have a little bit of overseas equities, but it's a set it and forget it setup that is supposed to protect you no matter what the market does from there forward, whether it's going up, down, or sideways. The problem with the strategy is it just doesn't work very well anymore because, like old-fashioned cruise control in your car, some human intervention is necessary to keep you from killing yourself. For example, in the month of March, stock prices, bond prices, and gold prices all pretty aggressively declined throughout the whole month. So you were naked there. You didn't have anything that was protecting you on the downside. If you prefer to manage your own investments, we have 2 levels of research available. Our flagship Asbury Premium is for more serious investors and includes the latest updates on all of our models. You can find out more about this service by clicking the Research tab, which I'm pointing to right here, at the top of asburyresearch.com, and you can request further information, or if you have any questions, you want to set up a Zoom with us, you could do that right here by clicking on the Contact tab. We also have an entry-level Substack newsletter right here. It's $25 a month. Entry-level. It doesn't include any of our updates on our trading models, but it offers select reports. And we do have one model that we built specifically for our Substack, and we're going to show you that just a little bit later in the presentation. There's also a free version of this. So if you like the videos, you like our approach to markets, but aren't ready to commit to a paid service, you want to feel a little more comfortable with us, I strongly suggest that you sign up for the free version of the Substack. You can do that right here, asburyresearch.substack.com. It's a no-brainer. Feel free to sign up for that and be able to learn a little bit more about us for free. If you prefer a managed account, let's get back over here. If you prefer a managed account rather than a research service, we have created 4 model portfolios using our own models like the Correction Protection Model, or CPM, or the CEF model, which is our sector rotation model, as building blocks for the purpose of participating in the markets with less risk. There's 4 of these, and they all have different risk-reward profiles, from aggressive all the way to super conservative. There's a couple in the middle. These model portfolios have all been developed through rigorous 8-year back tests and have been trading in real time for almost 2 years by both individual investors and also by professional money managers. The model portfolios are designed to produce S&P 500-like performance, but with significantly less risk, or to produce relative outperformance versus the broad market, but with similar or slightly lower risk than the S&P. Through the first quarter of this year, all 4 model portfolios are outperforming the S&P 500 by various degrees, all with less risk. We'll take a closer look at all of these in just a few minutes. If you'd like more information about the model portfolios, click on Managed Accounts right here. Select the portfolio or portfolios that you're interested in. Full disclosure, every penny of my own money, of my own investment money that goes into the stock market is invested in all of our own models. So we're eating our own cooking. Okay, let's get to the reason you're here and look at some charts data and some of our own models. We're going to start by moving over to the Research Center, and we're going to let's shift gears here and look at the Asbury 6 first. This is part of the Keys to This Week report, which we're going to get to in just a couple of minutes. But let's look at the Asbury 6 first. The Asbury 6 is meant to be an indicator rather than a model. It's a daily indication of the broad market's internal strength. So we're looking at 6 different metrics, and we got to these 6 metrics by doing a lot of back testing. I wanted to find 6 metrics that were different than each other, but they would all give me a very good idea of what the tactical or day-to-day internal health of the market is. And we look at the rate of change in the S&P, relative performance of stocks versus high-yield bonds, investor asset flows, volatility, trading volume, and market breadth. They're all green. That means this is as tactically bullish in terms of market internals as this metric can be. Notice all these dates, all in April. April 2, we had a couple turn green, and then between 6, 7, and 8, April 6, 7, and 8, everything else followed suit. So A6, it's actually been positive since April the 6th. Since then, the S&P is up about 8.3%. And the way this works on our back tests is the A6 typically underperforms the S&P slightly, about 2% a year, annualized, going back to 2017. But the quality that we like for this particular indicator is that the maximum drawdown has been about a third of the S&P 500. The drawdown has been about 11.5% instead of 34% with about an 8-year look back. About 9 round turns a year. So in other words, it shifts from all green to 4 or more green, which is a positive signal, to 4 or more red, which is a negative signal, about 9 times a year. Let's shift over to the CEF model. You know what? Before we do that, let me talk about drawdowns a little bit. This is another chart that we're going to get to in just a moment. But for now, here's what I want to show you. This is drawdowns versus the required recovery to get back to where you were before the drawdown started. So I always like to use this one. 30% drawdown requires a 43% move back the other way to get to where you were, to get to where you started. The reason I like this one is in 2020, during COVID, we had a 34% drawdown. Now, fortunately for that one, we got back to where we were relatively quickly. It was still a larger move back than the move down. But the problem with this, especially if you're older, if you're an older investor, I'm an older investor, time starts to factor in. I always say that in football terms, we're in the 4th quarter of our investment lives. When you're in the 1st quarter, 1st half, when you're 30, 40s, you can dollar cost average, and you want the market to go down, so your dollar cost averaging gets you in at a lower price. Once you get to the 4th quarter, like I am, now you got the clock against you, and you want to make sure that you retain your lead through the rest of the game. And the way we do that is by limiting our drawdown. So this is why we harp on drawdown so much. It's a really important part of investing if you're an older investor. Next thing we're going to do is we're going to move over to the SEAF model. The SEAF model is our sector rotation model. It's a completely data-driven sector rotation model. It's an acronym for sector ETF asset flows. The model was created to quantitatively identify long and overweight opportunities in the U.S. market sectors by following the money as it moves around the 11 sector spiders. The SEAF model is always fully invested in the market, providing investors with a dynamic alternative to the traditional buy and hold portion of your portfolio. According to our backtests, the SEAF model has very significantly outperformed the S&P 500 on an annualized basis over the past 8 years, but with a lower maximum drawdown. Since inception, this is what SEAF looks like. So this is since inception for this particular model is the middle of 2018. This is a daily chart showing the S&P 500 in blue and SEAF in green. So you can see there's been a steady, although the wiggles are the same, right? Because all we're doing is we're focusing on 3 sectors instead of all of the 11 sectors that we can own via the S&P 500. We're choosing the 3, so the wiggles are the same, but you can see we're slowly pulling away from the S&P 500 as the years go on. SEAF has been trading in real time via managed accounts for both individual investors and portfolio managers. Let me move back here real quick so we can spend a little bit more time on SEAF. Trading in real time via managed accounts for both individual investors and portfolio managers for almost 2 years, and I have been trading it in my own account for much longer than that. In real-time trading, through the end of last week, the SEAF model is up 9.64% year-to-date and is outperforming the S&P by 6.75%. Currently, SEAF is overweight technology, XLK, materials, XLB, and communication services, XLC. Our back testing has showed us that we get the best performance. We're able to squeeze the most juice out of this model by always being invested in the top 3. The model is rebalanced every week on the weekend, and any changes to that allocation take place the following Monday on the opening. Next thing we're going to look at is we're going to look at our keys to this week report. This report comes out once a week, as the name suggests, typically towards the end of the week, and it allows us to look at, we probably look at 100 to 150 charts, and we pick out 10 charts, data series that we think are the most germane and the most important to pay attention to right now. So we're going to look at a couple of those. We're not going to look at all of them. We don't have time, but we'll look at some. And the first one we're going to look at is the S&P 500. Look at that move from the March 30 low. It's just, there was another message out of the White House here. I don't recall exactly what it was, but that's what caused the huge gap, which got us back above the 200-day moving average, back above the 50-day, and now we're making new all-time highs. The old all-time high at 70.02 is now key support for next week. Let's move on to our second chart. So what happened when the market was going down is we lost a lot of our leadership. We lost the Mag 7 and we lost both of the NASDAQs. The only thing that kept outperforming on a strategic basis was semiconductors, but by itself, it wasn't enough to hold the market up. So what we had here in December, on the 30th of December, red arrow right here, I should tell you what this is. This is the relative performance of MAGs, which is the ETF that tracks the Mag 7 versus the S&P 500. Started underperforming on a 63-day basis, which is a business quarter, on December 30th. That's when MAG started to roll over. That's when the stock market slowly started to roll over. Look what happened on April 15th. On April 14th, up here, MAGs moved back above its 200-day moving average. But more importantly for us, on April the 15th, it is now outperforming the S&P 500 again on a quarterly basis. That's a big deal. That tells me that this move has rhetoric driven as it may have been, the relative performance shifts are starting to support it. So we're seeing that here. As long as the Mag 7, as long as the NASDAQs keep outperforming the S&P 500, it's going to help the sustainability of this move. Next chart. Here's the SOX. This is what I was just talking about. This is the SOX index versus the S&P 500 down here, and it's 63-day moving average again. 63-day moving average is our strategic time period. No matter what we're looking at, our tactical time period is 21 days, which is a business month. Look what happened. It started outperforming on May 9th of last year. SOX started outperforming SPY. Each time it came down and tested that 63-day moving average. We had September 2nd, Nov 21st, D17th, and a couple of hits in March. They all held, so the SOX has been able to maintain its quarterly relative outperformance versus the S&P 500 through that entire period, which has helped to keep the market from falling faster when it was on its way down into the March lows. The next one we're going to look at is, this is SPY versus AG. AG is got a long name. It is it's the iShares Core U.S. Aggregate Bond ETF. So what we're looking down here on a relative basis is relative performance between stocks and bond prices. So what we saw here on February 12th is bonds started underperforming stocks. Excuse me. That gave us this sharp move down into the March 30 low. Look what's happening. As of April the 8th, stocks are outperforming bonds again. That is good for the market. That is really important for the sustainability of this move. This chart is really interesting to me. What we have here is the University of Michigan Consumer Sentiment Index. Monthly index, it goes back to 1978. Right now, the index is as low as it's been throughout the history of the series. Why do I care? Because historically, when this index is at its lows, we are usually within a few months of a major bottom in the stock market. Here's November of 2008. Here's June of 2022. So this is not actionable. This is not a timing tool, but this tells us that the market is bleak enough on stocks that somewhere in here, I don't know if the low that we made in March 30th is that low, or if we're going to have a retest. We use our tacticals for that. Our CPM and our Asbury 6 are going to tell us that, but it does tell us in this neighborhood, I'd say between now and the 4th of July, if we don't have an important bottom already in place, this metric over 50 years is telling us this is where we should be looking for one. And then here's number 8. This is small, medium, or large cap. And right now, we have been overweight small cap. This is small cap, which is the S&P 600 versus the S&P 1500, which is the combined total of the S&P 400, 500, and 600, which is small, medium, and large cap. So small cap started outperforming on a quarterly basis, 63 days again, on December the 3rd. It retested it at the end of the year. It retested it again in the middle of March, and it's retesting it now. That means in order for small cap to be able to keep outperforming, we need to see more outperformance here over the next week or so. One thing in our favor, or I should say in this idea's favor, note that SPSM, which is a small cap ETF, it eked out a brand new all-time high, not by much, but on April 17th, and that was Friday. So these are some of the key charts that we're watching and we think are the most important to watch in terms of the sustainability of this big rally over the next couple of weeks until I see you next, which is, I think, first week of May. Let's move forward. I told you that I would show you how our models are doing in real time, and here they are. So these are all available as SMAs, as separately managed accounts, and we also have them available for other portfolio managers via TAMPs. But the 4 that I wanted to focus on here is the 4 model portfolios. Asbury Aggressive, this is from January 2nd through the end of last week. Year to date, it's up 7.96%, outperforming the S&P by 5.07%. Here's our Asbury Balanced, up 6.88% on the year, outperforming the S&P by 3.99%. Asbury Conservative, up 5.50% for the year, outperforming the S&P by 2.61. Here's the Asbury Ultra Conservative, which is, as the name suggests, it's very, very risk averse. The biggest drawdown that it's had, looking back to the middle of 2018, was 9%, where the S&P drew down 34. So that's how we're doing. This is something else we're going to add here every couple of weeks. We're just going to check in and see how our model portfolios are doing. All of them were created using our own models, including CPM and the CEF model. All have similar or better defensive numbers than the S&P 500, including lower betas, lower standard deviation, and significantly lower maximum drawdowns, and much higher Sharpe ratios, if you know what those are. If not, there's an E at the end of Sharpe, and you can look it up on Investopedia and learn more about that. They're risk-adjusted returns. So again, contact us for fact sheets on each of these model portfolios or to set up an informational Zoom with us. Let's move back to where we were. And finally, the last thing that I want to do is take a look at our Substack. I told you we take a little closer look. Asbury Research Chart Focus, 3 different. That's what the Substack is called, Chart Focus. We have 3 different types of reports here. Our first one is very similar to Keys to This Week that we just looked at, which is available in the premium product. Has a big overview here. It talks about what's going on economically. I'm not going to read this whole thing, but hopefully you can freeze your screen if you like, and you can get a little bit more detail. And all we're doing here is we're looking at a lot of charts and trying to determine what's going on, what to pay attention to. The next thing that we have as a part of this is our sort report. I had mentioned that. So this is my son Jack's idea. I think it's a very good one. What we've done is we've taken a lot of different types of assets. Small cap, emerging markets, U.S. technology, global equities, ex-U.S., gold, crypto, commodities, crude oil, U.S. dollar, and U.S. interest rates. And we've looked at these particular ETFs. So what we're looking for in this diverse list is ETFs or areas of investment that have a positive trend, that have positive relative performance, either versus their parent or largely versus the S&P 500, and if they have positive money flows. Right now, the only 3 that are clicking on all 3 boxes are U.S. small cap, which we just looked at, emerging markets, we use EEM for that as a ticker, and U.S. technology, which we're looking at the Qs. The ticker symbol is QQQ. Coming soon on this particular report is we're going to add our rainbow charts. Our rainbow charts are historic graphs that show how the CEF model has changed, looking back over the past year. The CEF model, it ranks all 11 sector spiders that they're either going to be favored, they're going to be neutral, or they're going to be avoids. So that's just something to look for that we're going to be putting out as an addition here over the next, hopefully this month. So finally, both my son Jack and I were both interviewed by the Financial Press last week. I know a lot of people like to watch these interviews. They learn more about us. I was on the Schwab Network on Wednesday of last week, and Jack was interviewed by Investors Business Daily, or IBD, on Thursday. I can't tell you how cool it is to be able to watch your kid getting interviewed in the Financial Press. Anyway, both of these videos are available via the website. If you move here, let me move a couple things around, go down to About and go to Videos. All of our videos are there. So if you're interested to see what we had to say last week, that's where you go. So that's it. That wraps up our latest Asbury Research's Following the Money podcast. Our next one is tentatively scheduled for Sunday, May the 3rd. I hope to see you then. In the meantime, if you have any questions about or want more info on any of our research subscriptions or managed account services, you can contact us right here via the contact tab at asburyresearch.com. See you in 2 weeks. Enjoy the beginning of what looks to be, we're having a flood right now here in Chicago. The weather is slowly getting nicer. I hope it's nice where you live. We'll see you in 2 weeks. Make sure you like and subscribe.